Ladies and gentlemen, good day and welcome to Quess Corp Limited Q3 FY24 conference hosted by IIFL Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phones. Please note that this conference is being recorded. I now hand the conference to Mr. Balaji Subramani from IIFL Securities Limited. Please go ahead, sir.
Ladies and gentlemen, good morning and thank you for joining us on the post-result conference call of Quess Corp. It's my pleasure to introduce the senior management team of Quess who are here with us today to discuss the results. We have Mr. Guruprasad Srinivasan, ED and Group CEO, Mr. Kamalpal Hoda, Group CFO, Mr. Kushal Maheshwari, Head Investor Relations and Strategic Finance, Mr. Lohit Bhatia, President Workforce Management, Mr. Pinaki Kar, President Global Technology Solutions, Mr. Anand Sundarraj, President OAM, and Mr. Shekhar Garisa, President Product-led Businesses. We will begin the call with opening remarks by the management team, and thereafter we will open the call for a Q&A session. I would now like to hand over the call to Mr. Kushal Maheshwari to take proceedings forward. Thank you, and over to you, Kushal.
Thank you, Balaji. Just wanted to check with the operator again if everyone has been able to log in into the phone call. Aditya, can you confirm to me?
Yes, sir. 86 participants has been connected, sir.
Thank you very much. We'll proceed with the call.
Yes.
Good morning, everyone, and thank you for joining our Q3 FY24 earnings call. The information, data, and outlook shared by the management during the call is forward-looking, but subject to prevailing business conditions and government policy. All forward-looking statements are subject to economic growth or other risks faced by the company. Please refer to slide number 2 of investor presentation for the safe harbor clause. With that safe harbor, I will now hand over the call to our Group CEO, Mr. Guruprasad Srinivasan, for his opening call. Over to you, Guru.
Thank you, Kushal. Good morning, everyone. Thank you for joining us today and hope 2024 has been a great start for all. For Quess, profitable growth and consolidation of operations continues to be the key theme for the year. Our efforts in this direction has been showing results. During last 6 quarters, though the revenue has grown by 13%, EBITDA has grown by 34%, achieving a non-linear EBITDA growth during the period. During the quarter, we added over 10,000 associates and closed the quarter with a total employee strength of 557,000. The hiring environment was positive in industrial, BFSI, retail, telecom, and 2 specific sectors, e-commerce and FMCG saw a net headcount decline as festival season concluded in Q3. IT still continues to be impacted by global headwinds. Our sales engine continues to deliver, adding 170 new contracts with annual contract value of 416 crores, setting up us well with growth in coming quarters. We also took a significant step towards streamlining our corporate structure. As part of our simplification of corporate structure, Connect, Greenfield and MFX India business is amalgamated into Quess post NCLT approval in Q3. In addition to this, Quess had invested in Heptagon Technologies. Heptagon drives solution to develop system and create sustainable impact on digital trends for business enterprise such as product engineering, UX as a service, intelligent automation and managed services. Connect has a digital practice for enterprise applications, and combination of Heptagon and Connect digital practice will strengthen our market presence and a joint go-to-market in digital space under GTS platform. Key financial highlights. We recorded a revenue of 4,842 crore, a growth of 2% quarter-on-quarter and 8% year-on-year. EBITDA stands at 181 crore, growing up by 11% quarter-on-quarter and 24% year-on-year. EBITDA margins have improved by 29 basis points quarter-on-quarter and 48 basis points year-on-year. This was driven by consistent profitability growth in GTS platform. Our cash burn in terms of reduced by 50%. Focus on profitability growth in OEM platform as noted. Let me walk you through the business updates for Q4 focus areas. To begin with, workforce management platform. The headcount of the platform reached 4,44,000, which also includes about 34,000 headcount which was processed in the month of December as part of full and final. Adding a net add of 14,000 associates during the quarter, driving the increase in revenue by 3% and 12% year-on-year. Revenue growth from workforce is driven by wage increase and sales growth with a mix of 70 to 30. As most of our contracts are flat fee, this also puts pressure on the margin. We remain confident of our sales engine to drive growth. The platform added 87 new contracts during the quarter. Sourcing contributed to 28% of new hiring. Our general staffing business placed 62% of associates hired in Tier 2 and Tier 3 cities. Once again, signifying the depth and breadth of our sourcing capability and deployment capability. Now moving on specific to the general staffing business, we added 13,000 headcount during the quarter, led by manufacturing and telecom and the FSI sector. Over 30% of our new contracts added in Q3. Of the new contracts added in Q3, 30% of our new clients are first time getting into the staffing outsourced mode, validating the long-term trend towards the outsourcing. So we are seeing some level of consolidation and movement from informal to formal. Our vertical focus strategy has continued to yield dividend, with headcount growth in manufacturing and BFSI stood at 8% each on quarter-on-quarter basis. The momentum is expected to continue in Q4, and BFSI and manufacturing account for almost 18,000 open mandates out of total open mandates of 28K as of 31st December. In addition to business has built up scale in terms of the pipeline. Our pipeline is almost about 39,000 stands at 39,000 for Q4, which will drive the headcount over next coming quarters. In order to take advantage of the market opportunities, we continue to invest in our sourcing, account management, and new verticals. Specifically, retail and logistics will also operate as a separate vertical from Q4 onwards. As a result, we have seen a marginal decline in associate to core ratios based on the investment that we have made. However, our associate to core to associate ratio still remains best in class. IT staffing business, the Indian IT staffing and collection business continues to remain impacted by global headwinds. Current open mandate stands approximately about 1,200, a drop of 16% and 31% year-on-year. Focus continues to be on niche profile, GCC, BFSI, digital, and maximize our margins. So those are specific focus areas. Moving on to global technology solution platform. GTS continued its growth trajectory, delivering a non-linear EBITDA growth of 3% quarter-on-quarter and 19% year-on-year. EBITDA margin continues to move on. Increased by 220 basis points year-on-year and 48 basis points quarter-on-quarter, demonstrating both economies of scale and positive momentum towards higher value of service mix. The highlights of specific to GTS platform are as follows, starting with the Connect business services. Connect continues to maintain its momentum with 16 new clients addition. The business closed an order book over an ACV of 110 crore during the quarter, implying sustained revenue growth in coming quarters. In BPM sub-vertical, BFSI accounted for 35% of total annual contract value added. We also saw encouraging green shoots in auto, retail, and consumer goods sector. Consistent focus on execution has led business to be consistently ranked first or the second amongst the partners, where clients have onboarded multiple partners. Business achieved the highest ever NPS in our leading customers. Our are achieving an NPS of about 65 from an earlier score of 33. Our non-voice BPM business grew significantly, with collection business growing 25% year-on-year and F&I transaction processing business growing 29% year-on-year. The nature of this business has been one of the key drivers for margin enhancement of GTS platform, and we will continue to invest in our digital solutions to create market-leading solutions and platforms. The growth momentum in our customer experience business in Ulster continues to win about 21% year-on-year growth. This was driven by 30% year-on-year growth on international businesses. With significant growth in both number one and number two clients, the CXM business, significant growth on number one and number two customers in the CXM business by revenue. In platform-based services, the employee experience management vertical in Ulster continues to strengthen its market leader position with 4 million payslips processed during the quarter, a quarter-on-quarter growth of 4%, and the vertical added about 18 new logos in Q3 driven by BFSI, ITES, which demonstrates a robust pipeline of almost about 30 crore for Q4. One key highlight of EXM business growth in quarter was high order booking in international business compared to the domestic business. Going forward, the focus remains on the following: AI-led automation. Our BPM business is currently running 10 AI-powered engagements with clients. We will focus on expanding the same. International sales, EXM vertical in Ulster on back of encouraging international sales have tied up with solution partners in global markets to further enhance the growth. In international CXM business, growth momentum is slated to continue in Q4 as well, leveraging the further revenue realization from leading North American customers. Growth in digital and IT services, 5 new customers were signed up with an ACV of 21 crores spanning digital services in UX, UI, core ERP and CRM systems. Moving on to operating asset maintenance. Profitable growth remains the key theme for the quarter. As a result, even though the top line growth has been flat, platform EBITDA grew by 4% quarter-on-quarter and 16% year-on-year. IFMS added 15 new customers during the quarter. Additionally, 13 contracts with ACV of 75 crores are expected to be mobilized in Q4. We are seeing green shoots in healthcare, manufacturing, infra, and will continue to focus on same sector. Food and beverage saw a gross margin improvement of 18% quarter-on-quarter. The improvement in gross margin has brought in by improving operational efficiencies and mobilization of contracts won during H1. The focus areas for Q4 would be added new clients in order to set the base for next upcoming financial year. Security services added over 1,300 headcount in Q3, led by infra and manufacturing segments. As a result, the business saw a revenue growth of 4% and EBITDA growth of 9% quarter-on-quarter. Our sales pipeline remains strong and business will continue to head at present rate. Telecom active infra business continued its good run with best ever YTD revenue and EBITDA. 9-month FY24 revenue and EBITDA has shown a growth of 33% and 41% respectively. The business was awarded a significant 4G rollout contract with a TCV of over 90 crores, for which the deployment will start from Q4. Moving on to the product-led business. Audit had a great quarter on the business and the product front. The sales grew by 9% year-on-year by the enterprise sales in India despite continued slowdown in IT, which is a major contributor to our business. We successfully launched disruptive AI product, Founded 2.0, for 550 plus customers. Initial feedback has been very positive and it has been acknowledged as best in class. We expect to roll out the same to every customer by end of Q4. Despite market headwinds, our operational metrics on both candidate and recruiter side remains positive, with job posting up by 7% year-on-year and 6-month active users by 22% year-on-year. CSAT continues to remain healthy and 91% with CSAT remains healthy at 91%, while NPS scores are at all-time high, reflecting the improved product. EBITDA achieved is as per plan in Founded, remains on course to deliver break-even by Q4. Moving on to general updates. As we have communicated often all public forums, including including our quarterly call, our employees are our greatest assets. Their well-being is always on top of our mind. It gives me immense pleasure to inform you that Quess has been certified as Great Place to Work for 5th consecutive year. Our score in the survey has improved from 73 to 87 in past 5 years. GPTW survey has also recognized Quess as a leadership factory, acknowledging companies that have successfully established a culture centered around fostering exceptional leadership abilities on large scale. This recognition signifies the entrepreneurial spirit with the organization, strong HR process, and a modern inclusive culture. So this was the update. I will now hand over call to Kamal. Over to you, Kamal.
Thank you, Guru. Good morning, everybody, and thank you for joining us today. I extend a very warm welcome to everyone who has logged into this call. I hope you had a chance to look at the investor presentation and financial results for Q3 uploaded on our website. Let me now walk you through this quarter's financial performance. Revenue for the quarter stands at 4,842 crores, a growth of 8% year-on-year and 2% quarter-on-quarter. Our headcount stands at 5,57,000 as of December end, a net addition of 10,000 quarter-on-quarter, with key contributing sectors being BFSI, M&I, retail, telecom, and healthcare. Our EBITDA stands at 181 crores for the quarter, a growth of 24% year-on-year and 11% quarter-on-quarter. EBITDA margin stands at 3.7%, a growth of 29 basis points quarter-on-quarter. This increase was driven by the following 3 points: reduction of marketing product development spend as per plan in Founded, non-linear growth in profitability in our BTS vertical and improved margins due to business mix in OEM vertical, and volume growth and control cost to serve. Profit after tax decreased by 10% quarter-on-quarter to 64 crores due to exceptional non-cash write-off of goodwill of approximately 20 crores in one of our technology businesses. Excluding above one-off, our adjusted PAT stands at a healthy growth of 15% quarter-on-quarter at 84 crores. Our commitment to cash management and debt repayment continued in the quarter, with gross debt reducing to 419 crores, lowest in last 10 quarters, with a reduction of 53 crores during the quarter. Our DSOs reduced by 1 day compared to September 23 and now stands at 55 days. Moving on to platform-wise updates, starting with workforce management. Revenue stands at 3,430 crores, registering a growth of 12% year-on-year and 3% quarter-on-quarter. Growth is predominantly in general staffing business, with key sectors being manufacturing, BFSI, and retail. IT staffing and APAC professional staffing have remained muted over last few quarters. Due to global headwinds, however, we have ensured to mitigate such downturn through cost actions. EBITDA has seen a sequential growth of 3% quarter-on-quarter and 4% year-on-year at 90 crores. EBITDA margin percentage has seen a nominal 2 basis points decrease quarter-on-quarter due to cost pressure on account of wage inflation, with flat margins in general staffing businesses. The business continues to focus on increasing wallet share of value-added services in platform to offset the inflationary pressures. Moving on to GTS. GTS platform clocked a revenue of 588 crores for the quarter, an increase of 5% year-on-year and 1% quarter-on-quarter. Growth in revenue in this vertical has been challenging in this quarter due to muted investments in technology companies. EBITDA stands at 108 crores, growth of 19% year-on-year and 3% quarter-on-quarter. Non-voice services and improved international mix in new sales of EXM vertical, along with cost efficiencies from merger of Connect business, has aided to increase in overall profitability. Good order pipeline in Q3 across CLM, infrastructure, and digital IT services, including few from Middle East, gives us confidence on growth and margin profile moving into Q4. Moving on to operating asset management. Revenue clocked 695 crores for the quarter, a growth of 1% year-on-year and a degrowth of 1% quarter-on-quarter. Revenue growth saw some challenges due to rationalization of few large accounts with low margins. Pipeline for Q4 is promising, and we are confident to bounce back as a focused investment made into key sectors will yield results, as we move forward. EBITDA for this platform stands at 36 crores, a growth of 16% year-on-year and 4% quarter-on-quarter. Margin increase is aided by business mix change led by food and telecom businesses, including few customer margin initiatives taken across the platform. Moving on to product-led business, revenue clock for the quarter is 129 crores, a degrowth of 13% quarter-on-quarter. While founded sales have grown 9% year-on-year, our break-fix business has seen some degrowth as quarter two revenues were higher in spare servicing revenues booking due to seasonality. EBITDA losses excluding ESOPs reduced by 10 crores quarter-on-quarter and now stands at a negative 6 crores. This is largely driven due to reduction in marketing spend in founded, a step closer towards break-even by end of financial year as per our earlier guidance. Moving on to some tax updates, there are few developments in the tax matters from the last quarter. For financial year 17-18, our appeal is at ITAT and next hearing is expected in April 2024. For financial year 18-19, against the final order of the assessing officer post BRP, the company has filed an appeal in ITAT and next hearing scheduled in the current month, February 2024. For the year 19-20 and 20-21, the tax office had proposed a special audit in line with the previous 2 years. However, based on factual representation, the same has been dropped and the draft assessment order has been passed. The company has filed objections before DRP against all these adjustments proposed by the tax office. With this, now I open the floor for any Q&A.
Thank you, Kamal. We'll wait for a minute for the questions to file before we start the Q&A.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use headsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Balaji Subramani from IIFL Securities. Please go ahead, sir.
Congrats on a good set of numbers. I have a couple of questions. Firstly, there has been a 30 basis points YOY EBITDA margin improvement driven by OAM and GDS platforms, while the PLB segment losses have come down, which is again, in line with your guidance. Could you give some more color on what drove this and, how should we think about it going forward? The second question is on the focus on manufacturing and construction verticals, which you have highlighted in the past. Could you share some update on how your headcount has trended just in these two verticals in the last couple of years, and how do you see this panning out in future? Thank you.
Sure. Let me take the first question on margin. Yes, we have been, it's really, we are able to scale the margin level up. There are a couple of contributors to it, starting from first, the reduction in terms of the founded firm has really, pushed the margin percentage up for Q3 specifically. We were about 3.4%. From there, we have come to almost about 3.7%. There are a couple of more things that we are doing in organization in terms of, the tight control on cost to serve, which means the productivity or the efficiency is being measured, and we are ensuring to ensure that, the cost to serve is kept tight. If you look at it, it is also reflecting on our OEM platform. So from around 4.8% at a platform level we used to deliver, we have just delivered about 5.2% EBITDA. So, and of course there is definitely scope specifically in OEM for a little more room to work on the margin there. The other the contributor to this is the non-linear growth or thesis of non-linear growth coming in from GDS. So GDS has an efficiency to release higher margins compared to the revenue growth rate. So that is really playing in now. And I think if you look at the kind of addition of growth that is happening in non-voice business, which is also a high margin business, which has grown by 25% year-on-year. So, 3-4 aspects just to summarize. One is reduction in foundry. Second, tighter control on our cost to serve. Non-linear growth coming in from our technology business. And OEM, the mix change in OEM, which is contributing to a betterment of our increase in our margins.
Request Lohit, if you can give some color on the two verticals that Balaji has inquired about, manufacturing and construction. Over to you, Lohit.
Good morning, Balaji. I hope I'm clear and audible. So thank you very much for that question for WFM. To your specific point on M&I of the manufacturing segment and the construction segment, we are closer to the 70,000 mark today. This is a growth of about 34 to 38% year-on-year in the last year, and 46% in the prior year. In fact, since December 21, this entire segment has grown by almost 130%. This has become the third largest segment for Quess Workforce Management today after BFSI and retail. In the times to come, the way we are looking at manufacturing, there are a couple of things that I just wanted to add here. Number one, the transition of India from only a services economy to services come product and manufacturing economy. Second, aided by informal segment transitioning quickly to formal. The transition of rural India to urban India and to formal jobs. This, along with the PLI scheme and the kind of benefits and aid that the government is pushing as far as infrastructure development is concerned, for us, this is a segment to watch not just for this quarter, next quarter, or 1 or 2 years. This is a segment to continuously keep watching for at least a decade as far as India is concerned. So we feel that this is an area where we need to deeply invest. We have invested in sourcing and technology, and that is something that we will continue to do. I hope that answers the question.
Yeah, that is very helpful. Thank you.
Thank you.
Thank you. Our next question is from the line of Kavish from B&K Securities. Please go ahead, sir.
Hi, good morning all. Thanks for the opportunity. I have a few questions. So we have reported and continue to improve our strong margins on the GPS space. So can you elaborate on whether we have reached peak levels here or we can still grow? So what is the 2 to 3 year thought process here?
Thanks for the question. This is Pinaki here. I'm audible.
The voice is slightly muffled. Yeah.
Yes. So, that this result that you are seeing, that's a part of a well-calibrated strategy and the execution phase. If you go back 14 to 15 quarters, just to show whether it is sustainable, we always remain within a band from 16 to 18%, within the 200 basis point band. So that question like 3 years back, when we are at 16%, what we did was that we had optimized the cost structure with the economies of scale coming in and the operating efficiency, the normal thing, right? So that took us to around 16.5%. But what is driving the incremental another 200 basis points has been mainly the change of business mix towards higher value add. There are all 3 axes, right? The largest axis is if you see the movement from domestic to international. So these businesses 3 components mainly in TTO. They connect, which is mostly domestic. Then there is outside, which at that point of time was 50% domestic, 50% international, and in effect it is 100% international. So what has happened over the last few quarters, both Connect Digital as well as in outside, mainly in the CXM business, the growth has been disproportionately high on the international segment, which has higher realization as well as higher margin profile than domestic. And the CXM, like if we get into that, like so EXM in outside, it used to be 100% domestic. Last quarter, from an ACV booking perspective, for the first time, that was 55% international, 45% domestic. Which is like a forward-looking indicator for the quarter ahead. And another change in the mix from the platform nature has been
In the CLM, both voice and non-voice, if you see Connect today has around 42 to 43% voice business, 57-58% non-voice business, where collections obviously has a major part as well as the F&A DCM part. And both collections and F&A DCM had 25% and 28% growth rate respectively, which is higher than the voice business first. So it's an interplay of these, just to summarize, the efficient cost structure, changing business mix, and obviously a much bigger push towards international North American. I hope I've been able to answer your question.
Yeah, thanks for the explanation. Secondly, we have also reduced our losses in the product-led business, especially Founded. So we do remain on track to achieve break-even by the end of the year or say early next year, right? And the last question is that could you please elaborate on the impairment taken this quarter? Thank you.
I'll ask Shekhar to speak on Founded and give us color on the...
Yeah. On Founded, we have stayed on track on our plan that we shared with all of you about 3 quarters back. That as we go through the quarter, we'll continue the investments in product and marketing, which will taper down to the second half of the year once the product launch happens, which happened in the last quarter. And the revenue will continue to grow irrespective of what the external environment is, which is what is playing out. So from Q2 to Q3, the operational burn in the business has come down by more than half, and we are well on track to meet our projections or outlook that we've shared, which is close to break even for Q4. Thank you.
On impairment, good morning once again, Kamal this side. So this impairment represents the non-cash charge on goodwill, which was part of the original investment done by Quess in Heptagon. Guru did cover in his speech about the internal restructuring and the business contracts and employees of Heptagon, which is a subsidiary of Quess now being novated and transferred into Quess. And the synergies of Connect merger and then combining these contracts, which has led to this non-cash impairment, which is a one-time non-cash charge.
Kavish, hope this answers your question.
Sure. Thank you.
Thank you. Our next question is from the line of Raghuram NS from Yura India Ventures. Please go ahead, sir.
Yeah. Hello. Am I audible, please?
Yes.
Yeah. This was regarding the CXM and the EXM business that you guys have really now focused a lot of your management attention on. The CXM business, obviously, I do allude to what Mr. Pinakikar also mentioned, that there is a huge amount of growth on our focus on growing the international business. So is there any ACV kind of data that can be shared on what has been the total ACV booked in the last in the last 2-3 quarters? And very similar, I think I heard about 30 crores of ACV being booked in the Q3 quarter. And what would be the kind of growth that can be expected in the EXM business also?
Okay. Raghuram, thanks for the question. Pinaki are taking this. So, like 30 crores that you have seen on the EXM business, and as I told you that 55% of that was international for the first time compared to domestic. If you see similar numbers from the EXM business, what has been booked without giving anything like forward-looking in terms of revenue, but the book to bill, which is there, another 4-5 million. So, and which is mostly international. So 90% of it is international. So from that perspective, and just correlating to that, we have consistently last 3-4 quarters of 30% growth in the international business in all set in terms of revenue. And with the current book to bill ratio that we have, so I think by secondary strategy, we should be able to maintain that.
Also, just to add, specifically for EXM, the sales cycle is generally between Q2 and Q3. So, financial year and calendar year beginning, that's when the large transitions happen in that space in terms of the employee records and all of that. So, generally Q1 and Q2 is, generally Q4 and Q1 is slightly low.
Okay. No, I thought in India at least Q4 is a pretty large in terms of.
But Q4, those sales cycles would have got closed in Q3. So it would be, we would be getting into the migrations in Q4.
Oh, okay. So how does this compare with last year? If you can please share that kind of thing, with 30 crores, is it comparable? Is there a growth as compared to last year, same quarter?
It's around 45% more than last year compared.
Okay. Mainly driven by, as you mentioned, international business.
Mainly driven by international as well as the number of clients that the average ticket size as well as the number of clients that have got opened up in the last 3 quarters on the EXL side. Whereas on the CXL side. Whereas on the CXL side, it is mainly driven by 2 or 3 large accounts where there have been opportunities which are leveraging.
Okay. Thank you so much.
Thank you.
Thank you. Our next question is from the line of Mukul Garg from Motilal Oswal. Please go ahead, sir.
Yeah, I hope my audio is clear. So, obviously, to start with, I think great work on the PLB business. It looks like, you guys are on track to break even next quarter. So, great execution there. Just 2 questions from my side. First on, the workforce management business, how should we think about, avenues for margin improvement there? Especially, on the cost side, why you guys have been, trying to take action, and I understand there are limitations because of fixed price contracts. But the core to associate ratio has been trending downward. So, do you see any low-hanging fruits there which can be kind of plugged over next few quarters to improve the profitability? And on the client side, are you kind of trying to increase the average pricing, which can help you improve the profitability there?
I'll ask Noel to answer your question.
Morning, Mukul. How are you doing?
We're doing well, Noel.
As far as WFM margins are concerned, Mukul, we are currently at about 2.6. About a year back, we were closer to the 2.8% mark, but that was about 12 months to 15 months ago. WFM primarily has 3 large components today. There is WFM India general staffing business. As you know, it has 70% of the book is a flat service, and every time the revenue goes up or the wage inflation goes up, unfortunately, in a percentage term, the margin comes down. Though rupee terms, the margin accretive is better than before. The second element of WFM is the professional staffing, or what we call the IT business in India. And the third element is the overseas business. Last 12 months to 15 months has also seen a decline as far as the trend in professional staffing and the IT business is concerned, as is known to you what's happening in the broader market. Guru and Kamal also spoke about the international challenges and the headwinds that we are facing. So from a lot of perspective, if you really look at it, this is probably the bottom of where WFM today is. And with the advent of the professional staffing as a mix, both international and domestic, playing more than the speed of rate of growth from general staffing is one. Secondly, now come back to the specifics of general staffing itself. You alluded to core to FT ratio, and that's a right point. Our investments in manufacturing is tailored to take care of every site, every factory where the customer wants us to work. See, in M&I segment, one interesting thing is also we're not taking business from any international or large domestic company. We are rather taking the business away from local erstwhile contractors who've probably been in this business for 10, 20 or 30 years. And that transition to a large company like us is an area where we have to make that investment. You have to be closer to the customer, you have to be in the factory, and you have to disproportionately add, recruiters, sourcing and technology, which is where also the margin remains a little soft when you start playing this industry a bit. To the last point that you said about, trending margins with customers, we are in the band of 680 to about 700 gross margin PAPM as far as the general staffing business is concerned. In spite of all the challenges that we are hit with, given the competition in the general staffing space, we continue to hold ourselves there with a lot of work which has been happening in the VAS space. And value added as well as the growth, which over a period of time beyond the investment starts to give us results, we'll be able to see this inch forward. I think at some stage, Mukul and I have said this for a couple of years now, at some stage, both the client as well as competition will move away from a pricing only strategy and will start playing a service and a price strategy. Quess has been retaining itself there for many years now. We hope to see sometime into the future that also starts playing. I hope that gives you an overall color with what we are dealing with.
Thank you, Louis. Guru, the second question was on the operating asset management side. Can you just help us with a bit of color on the subsegments where you guys were able to take efficiency gain or cut a lower kind of margin clients, and how do you see it progress over next 1 to 2 years, both from growth as well as profitability perspective?
Sure. So, as you know, under operating asset maintenance, we have three set of sub-businesses. First one is into facility management, integrated facility management, then followed by security services and industrial and telecom business. So, if you look at the largest piece among these three are integrated facility management, of which we had, in past we have been interacting on this. Our exposure to IT services were pretty high pre-COVID, and we did change the strategy. And now, if you look at in the order of segment, manufacturing, tops across all segments within the facility. So, and we continue to grow in that segment. We have invested in terms of sales and acquisition platform separately in terms of the go-to-market there, followed by healthcare continues to grow for us, and BFSI. So these are the three segments which are driving specific growth. So also what we did is specifically for both security and facility, we did take a deeper stab in terms of the business KPIs and the profitability by customer. We did go through the rationalization of low margin contracts. Wherever we had to go and get for a price hike, we have done that. And wherever we had to seize the account, we have gone through and taken those hard decisions to get where we are today, and which is actually yielding well in our result in terms of the percentage getting better. The business mix in terms of food business, which is high margin business, is slowly, the mix is changing, and we are almost about close to about 20% of our contribution comes from food business now, which is also a healthy bottom line. So we have done all necessary correction in terms of KPI, productivity, efficiency. Our quote to associate stands at 105 per FTE in terms of the overall facility. So we have done everything right. One area which still we are continuing to do is put more effort on sales and go-to-market. So I think we have already done that in between Q3 and Q4, which we have invested in teams. So we are all, kind of prepared to get into the next financial year in a good positioning in this. So added to that, telecom business is doing really well. As I said in my initial speech, they're ahead of their AOP targets. On the back of 5G rollout, we are doing extremely well in that space. which is also contributing almost about 11% EBITDA margin that they deliver, uplifting the overall segment. So, I think overall, the house is in order now to get into the next financial year as a right from the right launch pad. Anuj, you want to add anything?
Yeah, thank you, Guru. Good morning. This is Anand here from OAM team. So if you see the last 2 quarters, our EBITDA margin is in the range of 5 to 5.2. So this is what we called out the previous year, that our focus is going to be profitable growth. So we had levers in food and telecom and other profitable business we did. So I think between short and medium term, we are on the right trajectory in terms of margin. When it comes to the top line growth, the focus is on sales. We are adding new clients, but in the last 3 quarters, we focused on swapping some of the existing clients who are not profitable. That given us results. So we are confident with the new ACVs and pipeline. Starting from Q1, we will see better results coming from the top line. Thank you.
Great. Thanks. Best of luck for calendar year 24. I'll get back into the queue. Thank you.
Thank you.
Thank you. Our next question is from the line of Alok Deshpande from Nuvama Institutional Equities. Please go ahead, sir.
Hello? Can you hear us?
Hello, can you hear us?
Just a minute. He got disconnected, sir.
Okay. You can continue to the next question.
Okay, sir. Next question is from the line of Pratik from Quess Corp. Please go ahead, sir.
Hello, everyone. Just wanted to know what % of your revenue comes from outside India versus India.
Sorry. Can you repeat the question? There was
Yeah, just wanted to understand, what % of your revenue comes outside India? Considering all 4 business verticals.
So we have, our headcount, if I were to go, it's pretty, about 7,000 people we have across all our international geographies put together. And
Pratik, why don't I take this question offline and I'll get the relevant data and I'll mail it to you. You can send me the question over the mail. Okay?
Yeah. On which email ID? Okay, investor mail ID you mean to say?
You can send us on the investor relations email ID. Thank you.
Okay, sure. Yes. Thank you.
Operator, can we move on to the next question?
Wait. Our next question is from the line of Balaji Subramani from IIFL Securities. Please go ahead, sir.
I had a couple of follow-up questions. The first is on Founded. So, once you achieve EBITDA break-even, maybe by this quarter, what are your future plans for growth and profitability? And the second would be on the qualified audit opinion in this quarter. So while the 80JJAA dispute has been on for a few years, what triggered this qualified opinion this quarter? And you have also called out about 159 crores of contingent liability. So what is the exact demand from IT authorities, and what is the potential risk that you see? Thank you.
I'll ask Shikhar first to answer the question on Founded, and then Kamal will take over on your questions related to us.
Yeah. Thanks for the question on Founded. As you know, Founded follows the financial structure of a SaaS subscription business. So for us, achieving a break-even is a very important milestone in the journey of the company because most of our cost structure remains more or less flat from this point onwards, except for cost of sales. So once we achieve break-even, subsequent to that, thanks to the successful launch of our new product, we expect to continue our high sales growth. And as the sales growth comes through, it will have significant positive impact on profitability, as you can expect from any subscription SaaS companies once they achieve the threshold scale. So subsequent to the achievement of break-even, we continue to expect that the business will grow fast, and most of the top line that gets added from that point onwards adds disproportionately to our gross margins from there on, and therefore we expect the business to have significantly positive gross margins from the next year onwards.
Thank you. Thank you, Shikhar. I'll ask Kamal to answer the next part of your question.
Yeah. Thanks, Balaji, for this question. So I think there are two parts to your question. One is the present tax litigation and the claims of ADJJAA, and second, I think, is on the qualified opinion. So on the first one, if you actually expect, for both of them, if you refer to the note 5 that we have given as part of the notes to our quarterly results, for 4 years that the assessment has been done, for the 2 years which was FY18 and FY19, the assessment has been completed by the department and then Quess. We as an organization represented to DRP, and from there we are right now in tribunal. And as explained in my speech as well, the hearings are in the month of February, which is the current month, as well as in April lined up. And for the subsequent 2 years, we've got the draft assessment orders, and we are filing our points and legal grounds with the dispute resolution panel. Now, the cumulative potential impact for the company for all these 4 years for which the assessment has been done by the department is to the magnitude of 158 crores, which is what has been disclosed also as a contingent liability. Now, what happened during the current quarter is National Financial Reporting Authority, NFRA, in an order relating to certificates for these years issued by a chartered accountant pertaining to our claims of ADJJAA, has made certain observations of applicability of certain conditions of the IPM, which have also been very elaborately explained in Note 5 to the financial statement. For that matter, this order was subsequently stayed by the Honorable Delhi High Court on jurisdictional grounds of NAPRA on the chartered accountant. So as we speak, those proceedings have been stayed on jurisdiction. However, we continue to believe that our claim is valid, and we intend to vigorously contest our position on the interpretative stance of these sections on merit, including judicial precedents, and we believe we can strongly defend our position through legal process as defined under the Income Tax Act. The pure reason for a qualification, and if you read the qualification also, is on account of uncertainty which is there in respect of outcome and the timing that it will take for these matters. So the impact has been already mentioned in the financial statements of the contingent liability, and the uncertainty in terms of the outcome and the timing has led to this qualification. I hope I'm able to explain to your question.
Yeah, that is very clear. Thank you.
Thank you. Ladies and gentlemen, that was the last question for the day. I now hand the conference over to Mr. Kaushal Maheshwari for closing comments.
Thank you very much. Thank you for the interactive session. I would now ask our Group CEO, Mr. Guru Prasad, to close the call.
Thanks again for joining us for this Q3 earnings call. I would like to once again highlight that our consistent effort towards new logo addition, SG&A rationalization, and operational execution has shown a consecutive 6-quarter increase in EBITDA. Our effort is unwavering, and we will continue to scale new heights in coming quarters. Thank you so much for all your support. Thank you.
Thank you. On behalf of IIFL Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.